Thanks. Good evening, everyone. We'll kick it off. Firstly, apologies. Again, I'm a little bit crook, so my voice is not very well. Thank you for everyone joining us tonight. Again, appreciate the time to share with us. In this Get It Done series, we're joined again by our friends at OFX and Michael Judge. The whole point of this series is really to help the Australian expat community get things done. And a big part of that is our foreign exchange exposure. Most of us just think it's a very easy, simple process of going to the bank, exchanging what we need when we need it, but they're to help you manage and get the most out of your foreign exchange. Without further ado, I'll introduce Michael and we'll go through and hear his experience and what he has to share. There's a question and answer box, so if you have any questions, please put it in there. And we'll do a Q&A at the end. But as I said, we're joined by Michael Judge. He's born and raised in Sydney's Northern Beaches, has a Bachelor of Commerce and Diploma in Financial Services at Macquarie University. He's got over 10 years of experience in global financial markets as an AFMA foreign exchange dealer. He joined OFX in 2009 and oversees consumer and corporate segments of the ANZ market. And he provides regular insights and commentary to the business community and the media, including Business Insider, AFR, Macquarie Media, BBC, Sky News and other outlets. I'll hand it over to you, Michael.
Thank you, Jason. Appreciate the introduction. And of course, welcome everybody to this evening's webinar. Certainly quite late here in Sydney, and I know it is obviously a little bit late for everybody joining us in Hong Kong and specifically up in Asia. Delighted to be joining you tonight. Look, I think firstly for this evening, we'd love to keep tonight's webinar as conversational based as possible. Look, as Jason alluded to, there can be a lot of considerations which go into consumers, corporate, and a few other different customer types who are looking to either send or receive funds globally. And what we'll do this evening, look, we'll definitely unpack some of those details and some of those key considerations. But I think key for this evening's webinar will be more around everybody just hopefully having the opportunity to take away a couple of meaningful insights. I hope to provoke a little bit of thought around how people could better manage their FX. As I said, the practical reality is that moving funds from A to B or from B to A, or facilitating a cross-border payment, I suppose at a face level, it can be a thoughtless exercise. But obviously, the devil is often is in the detail, as they say. And tonight we will talk a little bit around that detail. And hopefully I'm in a place this evening to offer everyone a couple of guiding principles which can be universally applied across multiple situations to help improve your FX outcomes, particularly in what is a very fluid and at times obviously volatile market. But look, first things first, conscious that some people, look, they know something about OFX, others may know obviously more. But look, by way of introduction, OFX is a specialist provider of foreign exchange services. Our key role, frankly, speaks to removing some of the complexity, anxiety, and often some of the cost associated with either sending or receiving funds globally. Like many people on tonight's call, we are proudly Australian. We've got a very rich Australian heritage, which did culminate us floating on the ASX in 2013. And since that period of time, we're very proud to have established a global footprint. We've got banking partners. We are locally regulated. We have physical offices and people as such across 8 different locations. I'm just actually struggling, Andrew, to move through some of these slides. So just bear with me. What I might do, I'm just going to try reshare some of this evening's material. Okay, I'm going to assume everyone can now see that. Okay, fantastic. Thank you for that, Sophie. Look, as I was detailing, look, as I said, OFX, a rich Australian heritage. We've obviously now taken our business globally. We're very proud to represent more than 1 million customers. As I said, our key role here is to support customers who have, frankly, anything from a one-off payment to obviously customers which have a frequent, ongoing and repetitive requirement when transacting customers globally. Outside of OFX, one of the key roles I want to play today is obviously just to ground everyone around some basic FX principles. Now, yes, we're here to talk about FX risk management at its core, but really before we get to a broader understanding or some considerations around how you can better manage risk at a conceptual level, I think it was really important for us just to touch on some of the more foundational elements which are often involved in moving money globally. So look, as a consumer or an end user of a service like OFX, I think first things first, the starting principle here is that there is obviously an FX rate calculation which is involved. Across all spot payments or forward contracts, or frankly, any conversion of currency, there's always a buyer side and there's always a sell side to that underlying transaction. And I think at a foundational level, one of the biggest challenges that we often see presented, particularly to consumers, is that it's very difficult to understand comparative data. It's very also difficult to understand how rates are presented across different platforms, and equally how rates are presented across different types of providers. But I think the most simplest form to play this back to tonight's audience is to recognize the fact that players like OFX, players like banks and other non-banks as well, we would all consider ourselves wholesale providers of foreign exchange services. And what I mean by that is we actually have access to what we call interbank rates. Now, interbank rates is effectively the fundamental baseline to which all exchange rates are universally calculated. In all circumstances, what is presented to the end customer is simply the interbank exchange rate less a margin, and ultimately that is what we would call the end customer rate. So I think for people who are looking to enter into any type of exchange, obviously fairness in price and equally transparency around price is very important. Because as I said, comparing apples to apples, it can become relatively difficult when fee schedules, when margins are often not disclosed, and equally it can be very hard to unpack what or how valuable or competitive the rate being presented actually is. So simply what I would say, interbank rate, less a margin, and that is the customer rate. Customer rates as well can be very, well, I should say, are updated very frequently. It is a live exchange rate market, and having access to multiple customer rates can obviously be a really great mechanism to benchmark and frankly to keep people honest in today's market. As we move into the second key consideration here, and we're moving away from the simple aspects of FX rate calculations, I think a really important reality here is that underneath an exchange rate is obviously what I would call, the transit of funds. And if I use the example of an Aussie expat today living in Hong Kong, I would present the opportunity where, again, that customer is looking to convert Aussie dollars into Hong Kong dollars. Once an exchange rate has been secured, of course, there is a natural entry to the transaction and there's an exit to the transaction. And this is where partnering is really important. If you were to partner with, again, if I use a homegrown example, be it in OFX's circumstance, a customer in that equation would simply be making one push payment domestically in Australian dollars from the AUD account into our AUD account. It is a local domestic payment. Upon receiving those funds, OFX would then release out of a pre-funded, locally based Hong Kong dollar HK-based account, they would release that payment into your nominated recipient. Now, in that, I suppose, scenario of money movement, the key call out here is that there is no global transaction. The funds do not cross a border. The funds are not wired or telegraphically transferred from Australia into Hong Kong. There are simply two-sided, double-sided, two domestic payments. Aussie to Aussie, Hong Kong dollars to Hong Kong dollars. And this, frankly, is why the maturity of an operator obviously works. And things like, obviously, not just the safe passageway of money, but the efficiency of the underlying payment can really present gains for the end user. Things like speed, things like cost, and things like visibility of the payment are all enhanced when you can either use a local bucket of collection or a local exit point for the underlying payment. And the example I've just presented, again, there's a local bucket of collection in Australia and there's a local exit point. So look, I think a lot of the inquiries that we often base outside of receiving a competitive exchange rate is around massaging the underlying payment of funds. And this is a really nice segue into safety and why compliance and risk matters. I think we really appreciate at OFX the fact that when we're handling people's money, obviously it can be quite an unnerving experience. particularly if you're a global investor or, for example, you're looking to make a property purchase in Australia. We are talking large parcels of funds, we're talking meaningful transaction values. In that scenario, there can often be a little bit of a time lag between, funds exiting your Aussie account and then, being received in Hong Kong dollars, or, vice versa, funds exiting your Hong Kong dollar account and landing. And our role here is to obviously remove a lot of that anxiety, make sure there is a safe passageway and ultimately the most efficient passageway of funds in either of those two directions. So compliance matters not only to ensure, the safe passageway of the payment, but obviously we play a critical role, to ensure that the obligations and responsibilities laid out from our regulators are met, and equally that we do present, strong corporate governance and a strong compliance culture. Compliance, AML and KYC actually really do matter in an environment which is only frankly becoming more and more regulated. I think in later parts, I'll probably press hold a little bit on number 4 here, which is more related to a topic we'll probably cover later on, which is more so related to some of the influence of FX rates. As I mentioned, the FX industry, it is the largest financial industry in the world. It spans, frankly, every corner of the universe. There are a lot of factors, but 2 or 3 that we're really probably going to go a little bit deeper on in later parts. We'll speak to the fact, look, things like the underlying currency, the reality is fundamentally they're probably swayed by only a couple of key things. One is interest rates, one is, I suppose, the underlying risk settings of the environment at any particular point in time. And the third piece, I should say, speaks to an assessment of economic health when comparing one country to another, or I think more importantly, one currency to another. As I said, there could be a lot of questions around what's the Australian dollar doing? What are we seeing as being a key driver of a particular currency corridor? As mentioned, there'll be an opportunity to talk specifically around our read and some of those influences, hopefully in later parts. So look, before we jump into FX risk management, look, I think today the reality is I'm mindful that a lot of these scenarios which we've outlined on this slide are actually some of the things which are being obviously played out in a live environment. There are a lot of use cases that we see across our consumer portfolio, but a lot of typical customer scenarios, I should say, are those which I've got here. So look, what we've really seen over the last couple of years is obviously a lot of Australian-based investors who are looking to make global investment decisions. They might be purchasing foreign property assets offshore, or equally, we do see a lot of expat communities globally looking to make property purchases back into Australia. We have also seen an explosion of rental repatriation for those who are based offshore. We are also very proud on this third point here around our recent strategic partnership with the Australian Tax Office, which does allow a lot of Australians based abroad the ability to make Australian tax payments via a relationship directly with the ATO. So I think, look, a lot of typical scenarios which have really been accelerated, particularly in the COVID environment over the last kind of 2 to 3 years, is investment-based transfer. And that can be Australians making global property purchases or global equity purchases offshore. The associated, obviously, rental or yield or dividend returns associated with those underlying investments. And as I said, obviously, finally, we're very proud of that linkage to the ATO, which speaks more to tax payments when based globally. Okay, so changing tack slightly, and as I mentioned in my introduction, we wanted to spend a fair bit of time this evening talking about FX risk management. The reality is when making choices related to timing or making currency choices, which in hindsight might prove to be right or wrong, I think the really important message that I want to start with here around managing FX risk, and that is to say, making the right currency choices and managing risk is not necessarily baseline to getting a choice or getting a choice wrong. This really is around risk mitigation. And what that means, predominantly is, I suppose, acknowledging the fact that over any given period of time, an exchange rate can gyrate, peaks, troughs. If you were to put a line through a graph at any particular point in time, and this is a fantastic example, the reality is you're going to see some good moments in time to transact, and you're going to see some great moments in time to transact. But what FX risk management, frankly, is all about is more so around, I suppose, navigating around some of those nasty edges. And we'll talk, in later parts around some techniques to help achieve a little bit of smoothing or a little bit of layering to help avoid some of those nasty edges.
Hey, Michael, I just want to interrupt you for a sec. I think your mic is rubbing on your collar or something. It's
Okay.
a bit of interference. That's better.
Okay, thank you.
you.
So what I'd say firstly is logical place to start here is effectively just to understand what is FX risk. And I think the proper definition related to FX risk, it really is related to the losses that an international transaction or an international transfer may incur due to fluctuations in the value of two currencies. And what we can see here is if a customer were to have transacted on the 2nd of December in 2021 versus having transacted on the 2nd of March 2022, very short period of time, a reasonable parcel size of 50,000 US dollars. The additional cost in transacting on December 2 versus the 2nd of March is in fact close to 2,000 AUD. So what you'll typically see over larger parcel sizes, over larger timeframes, again, these risks can obviously start to get, frankly, quite elevated. So that is a really nice segue of understanding why FX risk matters. I mentioned a little bit earlier, if we look at this slide, and I suppose the picture that we're trying to illustrate here is to say exchange rates can go either which side of this blue line through the slide. A blue line, for example, might represent a satisfactory or in fact a medium style of FX outcome over any given period of time. Naturally, all consumers or all businesses would love to be participating only in this yellow quadrant when it's favorable above that baseline. But naturally, you do want to put in some natural mechanisms to help navigate, again, some of those nasty edges, or I suppose route around a scenario where you might be forced to participate in an unfavorable environment. And when you understand, I suppose, why FX risk matters, I think the reality is there are significant risks, frankly, in doing nothing. And there are significant risks in making improper choices in improper market settings. So I think one example here is to say, look, let's assume you're an Australian-based business. If you're an Australian-based business, what we know, particularly for Australian-based businesses who are predominantly import-heavy, in a typical falling AUD environment, the risk which immediately presents is specifically related to an increase in cost. As increased costs, that's obviously going to affect the top line of your business. Profitability over the longer term will suffer. But what's actually an important call out here speaks more to the competitiveness of your business if you were not active in protecting in a falling market. And what I mean by that is if one of your competitors, for example, and if you look in again, the yellow quadrant of this little graph here, if one of your competitors was to have been really active and were to have hedged actively at a superior rate to you, they have a natural built-in competitive advantage because they've got elasticity in terms of how they can set prices for the end customer. So if you are in a very competitive industry where there isn't natural elasticity, which allows you to flex your prices when setting prices to your end customer. Again, if someone has been able to capture super strong rates over a sustained period, if they've been active in managing their FX risk versus someone who has been quite passive and has ridden that depreciation, naturally you can start to see that you will shortly become very uncompetitive in an otherwise competitive landscape. So in that scenario, again, there's this payoff here to say, look, payoffs are naturally in hindsight and in hindsight only. But what I do want to pivot towards to say that, look, FX risk management and having a very fundamental and disciplined approach to planning around some of these surprises can actually help mitigate the risk and to reduce some of that downside. Okay. So once you're starting to get a feel here, I hope, to say what FX risk management is about. And if you are a consumer who's looking to make a property purchase in Australia, if you are a Aussie individual who is looking to manage your income across two different countries, across multiple currencies, now, what I would typically suggest is there is this fundamental need to assess and understand the risk which you face. And I think that the reality is, in terms of risk, the most obvious risk that many people face is actually more based at a transactional level. So again, the example I would offer up would be, look, a Aussie base who's living in Hong Kong today, let's say they've purchased a property in Australia. In that scenario, their risks are defined in a set duration of time. They know that the risk presented, look, they might run anywhere between 1 day up to potentially 6 to 8 weeks based on a settlement period. The risk is defined by, to some extent, the cost of your underlying purchase. So in that circumstance, you've got a fair bit of certainty around the parameters at play here. You've got a defined time period and you've got a defined exposure level. That transactional based risk, I suppose, by definition, it is very different to a lot of the risk businesses. Again, if you are an Australian-based business and you're importing regularly from Hong Kong, in that circumstance, you're really getting more to an economic style of risk. It is prolonged, it is frequent, it's across multiple cycles. It could actually be across multiple different currency corridors. That economic risk, it presents, I suppose, added complexity, and a very basic currency plan may actually not be fit for purpose in that type of scenario. But I think basically at a transactional level, I think the key call out here, and I'll move quickly to some of the key considerations when managing FX risk. And if I baseline this back to the example that I presented in terms of Aussie who is based in Hong Kong and purchasing Australian-based property, one of the real first key call outs here is to say, look, consumers do have choice. And they do have choice in using that full settlement period to their advantage to help manage the underlying risk. What we'll typically see is that an Australian might, for example, buy a property and immediately their mind will turn to buying Australian dollars. They'll race to the starting point and say, look, I've got a requirement. What's the rate doing today? Let's convert the currency. Let's get this thing done today. And in creating that urgency, in fact, what is happening is that they are in fact crystallizing their risk and really amplifying their risk on one particular day at one particular point in time in that day. Now, in hindsight, that actually might deliver them an optimal outcome. The rate might decline significantly. Day one might actually, in hindsight, represent the best time to execute that payment. And I think that may hold true, but the reality is that outcome does not hold true in the absence of significant risk. And I think where using time to your advantage is a superior, methodology to approaching that transaction is to say, if you were to break that payment down into multiple tranches and to, potentially break it down into 6 payments over a 6-week payment schedule, at the end of that 6-week payment schedule, what you would be able to do is to reflect on the average FX outcome over the full period of that settlement. And in that scenario, again, you should be able to determine that, yes, at any given particular point in time, the exchange rate may have been higher, it may have been lower, but you will see a nice layering or a nice averaging kind of impact or outcome achieved over that period. And that truly is around risk mitigation. Again, you haven't optimized the top side, but you've been very active in managing some of that downside risk, which would present over the duration of that transaction. So again, a very basic example of how you can assess a risk by way of duration, by way of value, and putting in place, a more active consideration and more active participation in the market to achieve a satisfactory outcome, which is neither good nor bad, but equally, again, it is prefaced against risk mitigation. So look, I think it is really important to understand the size and the duration of that risk. But I think the second part here is around setting some very basic objectives. And I think, again, examples here are really important. So the first example I'd touch on around some of the basic objectives we see customers adopt quite frequently. One is what we would call setting yourself up for a target for a particular transaction or for a particular point in time. Now, the reality is there are a range of products available to both businesses and to some extent consumers who can effectively partner with a specialist, execute using the right mix of products, and in doing so, you can actually either defend or achieve those, well, effectively predetermined exchange rate outcomes. So what I mean by that is, look, if we look at the Aussie-US corridor today, for example, the exchange rate today is, a little north of 75 US cents. An importer might be looking out to the horizon and they might have a degree of certainty over how much US dollars they might say need in the next quarter. And what they will do there is they'll say, look, I can create a little bit of certainty in my cost base. I can receive from assurances around what my revenue profile is going to look like in the first 90 days of my financial year. If I can achieve an FX outcome of 74 US cents. And once you've set that baseline and you've made some assumptions and you've got some certainty within your business, you can obviously come to a partner and you can start to pair up that objective with a fit for purpose set of products. Outside of setting a target rate, again, another really common objective that we see used often is what we would call a hedge ratio. And if I use that very same example of an Australian-based importer who has currency risk across Aussie and US dollar windows, they might take a view at the beginning of the quarter to simply say, look, I would like to have certainty and I would like to hedge a set percentage of my requirement. And they might go in actively on day one and they will layer out 70% of their known defined requirement. And obviously they are happy to participate on the upside for the other 30%. And equally, they can absorb any of the negative consequence for 30% of that parcel as well. But they've been very considered in setting that 70% objective, and they are happy to participate on the remaining 30% of their exposure. So again, another very basic tip or objective, which we will often see play out and inform part of an underlying currency plan. So before I move forward and talk a little around product choice, because obviously that is a very important component. Some of the key considerations, and I've touched on some of these already around managing FX risk. I've used the term partnership and obviously currency specialism quite regularly tonight. What I would say for basic FX requirements, for one-off requirements, there are a range of very user-friendly digital platforms which are available to consumers and businesses. But when you are getting into considerations around FX risk management, if you feel like you need a little bit of steer, frankly, around some of the things we've spoken about today, then equally that partnership and that co-created plan can actually become quite compelling. What I would say as well is, look, stay informed and situationally aware. The market of today is certainly not going to be the market of next month. And as I said, it is really important to stress test not just some of your assumptions, but obviously, just ensuring that your currency plan is overlaid adequately to the situations of today or the situations of next month. We've talked a little bit already around using time to your advantage. I said we see two scenarios play out quite frequently. One is reference back to that situation where an FX risk is defined and there's this real sense of urgency to, frankly, make a decision. The other component around using time to your advantage is, again, you'll typically see added fear, added anxiety, added, again, urgency when the spot market, it's directionally not pointing where the end user wants it to. And it's in that scenario, again, that the benefits of, I would call, a currency plan is really important. You do want a little bit of an anchoring point just to help manage some of those emotions which can surface, as I said, when the spot market isn't necessarily trending in the right direction for you. So look, outside of key considerations, certainly a couple of things on top of that to look out for. Look, overhedging, very important. What I would say is that overhedging can happen in a couple of different scenarios. But for example, if you are, again, I'll reuse that use case of Hong Kong-based Aussie property purchase in Australia. Overhedging can be linked to potentially hedging a full parcel size in the absence of contracts being exchanged. The risk there is that you've got a currency commitment and the underlying transaction to pair that commitment with, that is a scenario which will leave an end consumer overhedged. It doesn't actually necessarily have a realized cost. It can have a frankly uncapped consequence by way of risk. So overhedging, it's something to obviously be mindful of. I'll route around the second point here, which is being hypersensitive to movements in the spot market, being situationally aware. Again, you will over time be informed adequately enough to figure out what is noise versus potentially something fundamentally more profound. And equally, in having quite an active consideration around currency planning, again, you might be able to put some of those principles in to defend against that initial first response. Finally, look, the use of the overuse of complex derivatives. It's certainly not something that we're confronted with too often here at OFX, but again, there has been a lot of situations where, again, customers have married themselves to products which are frankly either not fit for purpose or equally are a little bit too complex for what can be overall a pretty structured and hopefully simplified requirement. So look, in terms of products, as I said, that third or fourth quadrant around currency planning, understand your risk, set some objectives. This is where you really want to work with your specialist to understand what your options are from a product perspective. We do have a couple of products. I'm not going to spend too much time wading through them. We're very proud to offer what we call global currency accounts. So the benefit of a global currency account is that, it does allow our customers to have, again, localized buckets of collection. It can support what we would call currency netting. So again, if you're renting out if you're renting out a property as an investor in Australia, if you are capturing rental returns off the back of that, the easiest way to mitigate risk in regards to the repatriation of those funds into Hong Kong is to make sure that you have adequate balances to cover your Australian dollar costs before repatriating those funds back to Hong Kong. Whether it's council rates, maintenance, ongoing property costs, obviously building up a little bit of AU-dominated cash to make sure that you are covering those expenses before you repatriate any excesses. Great example, frankly, of, in a very basic sense, risk mitigation, but equally cash flow management more than anything. Now, you don't want to find yourself having to deal with the efficiencies of what would be a two-sided and frankly unrequired currency conversion. Unrequired be it, look, you basically be creating an AUD to Hong Kong dollar payment only to again have to do a Hong Kong to Aussie dollar payment in the inverse direction down the line. Very inefficient way to obviously manage or do netting. We do offer things as well like limit orders. Again, I talked about setting some target rates. It's a great way to set and forget, if you like, or in fact, to set some rate alerts and set some limit orders out there. Your provider can actually do the watching for you and can actually catch certain rates if and when they transpire in the market. Look, finally, situationally aware is a phrase which I've talked a little bit about tonight. We're very proud to offer an app where obviously, customers can receive live quotes. They can execute payments via their app as well. And there are a range of informative publications by way of daily and weekly commentaries available as well. So look, currency pair considerations. I hadn't necessarily planned to talk about any particular corridor, so I'm more than happy to field questions in regards to any currency corridor in particular. I'll certainly do my best to give my read, frankly, more than anything. Once upon a time, I was very active with customers and obviously very close to the market. Still am today, definitely a passion of mine. But if there are, as I said, corridor-specific questions, happy to field them as well. But look, before we wrap up, probably questioning whether we need to talk too much around client examples. I've been quite deliberate this evening to present Aussie relevant examples, if you like. I'm mindful that a lot of the use cases presented today are around those scenarios around, investment decisions and paired to typically an Asian to Aussie up into Asia kind of currency leg. So what I would do, look, as I said, more than happy to jump into some Q&A if there are any questions across the floor this evening.
Thank you so much for that, Michael. Always informative. Everyone, please don't forget to put your questions in the Q&A chat box. So while those questions come through, fun fact for those that don't know, I used to be an FX dealer at Westpac, and what I learned at my time there, and I was an FX dealer just before the GFC. And what I learned there was that there's never the best time to exchange, and having a currency plan as detailed by Michael can take that sting out of, oh, I exchanged a week too early or a week too late or anything like that. Everything we do, the whole point of this seminar the whole point of the series is to help people get things done, is to understand what you're doing and why you're doing it, and then obviously plan for it. So again, thank you, Michael. So we've got a few questions here. What's the impact on the AUD if the Ukraine-Russia conflict is prolonged?
Yeah, sure. Look, I think at the moment, the AUD USD corridor, look, it's north of a 12-month high at the moment. It's directionally very strong. I think that's the kind of the first call out. I think what everybody appreciates universally around the AUD is its linkages to commodity prices more than Australia is what I would call a net exporter of energy and a net exporter of a lot of rich commodity-based resources. And what we've really seen play out for a little while now is a huge appreciation in underlying commodity prices. So what that means is that if we are exporting nationally a huge amount of natural resources, we're actually collecting in AUD terms a lot of income. We're seeing our national accounts, they're looking quite healthy. Income streams off the back of these sales is frankly enormous. And those income sales are not only driven by demand or volume, obviously they are dramatically supported by higher prices. So frankly, that scenario is net positive for the AUD, and that's really what we're seeing at the moment. Look, if you were to chart the AUD, if you were to line it up to say the iron ore price, if you were to tie it to the current spot price in copper, the two very connected and heavily connected. And what we're really seeing at the moment is the weight of that commodity narrative is really playing a supportive role. And frankly, more so to your question linked to obviously the conflicts that we're seeing in Eastern Europe right now. So I think in the absence of that tailwind, which is promoted by the strength of commodity prices, look, I think the AUD would be lower. It has done a really good job of just navigating some of those risks. And we know the AUD typically is quite sensitive or hypersensitive, if you like, to risk flare-ups. But at the moment, look, I think the tailwinds are strong. I think if there were to be some additional upside, look, I think it's probably more off the back of a continuation of the commodities piece more than anything, Jason.
Okay, thank you for that. A few of the same questions. On the back of that, what's your forecast for the AUD over the next sort of 6 to 12 months?
Yeah, look, I'd probably just tie that back to some of my starting commentary there. Look, I think if you are in the boat to say the commodity journey, look, if it's probably a Q3 versus Q4 journey point, look, I think there's nothing necessarily to say the AUD can't retain levels north of 75. It would be very surprising for a lot of people, I think, for the Aussie to see an 8 in front of it in that 6 or 12-month period. But look, I think at the moment, there's probably more upside bias than there is downside, if anything, Jason.
Okay, thank you. Got a question here. Not sure if you can answer it, but if I am repatriating funds that are profit from overseas property sales, do you advise on tax implication, e.g. property in US versus Hong Kong?
No, I can answer it. I can't answer it. The simple answer there, Jason, is we're certainly not tax advisors. I don't know what the tax implications of different investment types, nor what the implications look like across different jurisdictions. Look, it's a question I've definitely been asked before. We've got global citizens through our portfolio. We've got global citizens which have very different looking investment portfolios themselves. Yeah, naturally, there's going to be tax consideration within their portfolios. Obviously, we're here to support the settlement of those liabilities, but naturally can't speak to any particulars necessarily.
Yeah, okay. What I'll add to that is obviously the best persons or people to speak to are tax advisors. And for this question, I'll email the person asking the question a contact that you can speak to in regards to this. We're not tax advisors, so definitely can't advise on that. Okay, we'll move to the next question. Oh, okay. With China's growth, when will the RMB play a bigger role in the market?
Yeah, look, I think what a lot of people need to appreciate is for a currency to be widely acceptable or frankly widely accessible, a couple of things need to play out. And the first thing is that if you're going to provide a service, frankly, you need to be located. And not only do you need to be located in China, obviously you do need to be locally regulated and you do need local banking support. And frankly, at the moment, achieving all of those three things at the moment continues to be quite difficult. So look, I think everybody appreciates, particularly in China, their growth momentum. Obviously, they've got a critical mass, but frankly right now, by way of the economic clout. And look, that growth narrative is nothing new. It's certainly continuing to play out. But the renminbi, it still is quite a prohibitive currency, both to access and both to buy and sell. Because from an outside-in perspective, there are things still around foreign capital controls. And as I said, achieving those three things, which is local office, local people, locally regulated with a local banking counterpart. At the moment, achieving those three things, it's a difficult thing to do. So in the absence of accessibility to those three things, it continues to be a difficult pursuit more than anything.
Okay, thank you for that. So how can we trust OFX to send our money? Is it safe?
Yeah, look, I touched on the safety element a little bit earlier, but again, safety is absolutely paramount. I think when you are looking to transfer funds, whether it be with OFX or anybody else, the typical lens, which I'd probably recommend everyone to assess, is firstly at a regulatory perspective. We are a highly regulated industry and a highly regulated business within that industry. So obviously you do want a degree of visibility over things like your license, things like your regulatory standards. I think that is really important. Obviously partnering with somebody which has a degree of maturity in terms of how they're constructed, locally licensed, locally banker parts, accessible people, a really strong portfolio of banking partners. That safety aspect, it probably is the combination of all of those things. And when we are frankly prompted around safety, we talk to all of those. I would say as well, particularly in this age of digitalization, safety and trust in customer, it actually goes probably one or two steps further right now than it ever has before. And matters related to fraud detection, fraud prevention, and fraud screening, obviously very important to customer. The ability to catch these things, the ability for any provider to prevent and detect is very important. Issues related to privacy retention and issues related to cybersecurity. These are all very paramount at OFX. And I think a lot of those risks to ensure safe issuance of product and safe passageway of payment. Yeah, I 100% respect more than anything and appreciate more than anything the importance of those pieces. And again, there are a couple of considerations, which I think I've mentioned. It can be privacy, it can be fraud prevention, it can be cybersecurity, all the way through to the licensing regulatory pieces. So a pretty big and rounded answer to the question, but I think as a starting premise, you need to do a little bit of due diligence, more so just around the licensing, because if you are licensed, the type of assurances which can be provided are frankly very similar to that of the banks here in Australia.
Yeah, thank you. Thanks for that, Michael. Maybe you could go to the next slide. So there's some contact details for everybody to take down. So for those that don't know, I've been working with OFX for quite some time, helping the Australian community in Hong Kong and Asia. I think that first link there, that first link there is for those that aren't already using OFX. So by clicking on that, we've got a corporate program with OFX. So Jason Lam Finance and OFX has a partnership there. So you get preferential rates as well as fee-free transfers. And also we've got a dedicated account manager, Andrew Lee, that you can contact there as well. So take that down. We'll also send, is it okay to send the slides, Michael, to the audience? Yeah.
Yeah, I believe that should be fine, Jason.
Excellent. So we'll send that out as well. So let me have a look here. So converting a US property asset to cash in the US has tax implications in the US, but profit on the transfer from USD to AUD seems to be a little gray. As a rule, only move money when you are doing something with it. I think that's a statement, but anything you want to add to that, Michael?
No, I don't think so, Jason. No.
Yeah, okay. That's a good comment. Something I'll definitely ask my accounting contact. So those that don't know, Tommy did one of our other sessions, but I think most FX providers encourage transfers only for the purposes of a purpose rather than speculation. Is that your stance as well, Michael?
Look, I think it's a good call out. And obviously, there are different types of FX mechanisms and providers. Now, obviously, we provide a deliverable style of service. So yes, the people who are engaging in working with us, there's obviously an underlying need, and FX is more the enabler to that need versus, say, a speculative or a CFD style of mechanism. Obviously, very different. Yes, we are the enabler between B and A or A and B. The underlying use case is obviously unique to a customer.
Excellent. And I think this is the last question. So is OFX for personal use only or for business as well? Can it be for business as well?
Yeah, so we actually support a couple of different customers, and we've actually got 3 or 4 key segments at OFX. Now, obviously, one of our core segments is private clients or our consumer business. I think actually, as of today, one of the larger of the 2 portfolios, in fact, our corporate or our B2B channel. So simply, yes, we do support corporates of all different shapes and sizes. We do also support what we call online sellers, and we do have an e-commerce business. So not just businesses in general, but businesses who are either selling through global marketplaces or frankly, businesses who are selling through their own channels, i.e. their own website. Just finally looked at a couple of other segments, and we do provide our services to enterprise customers. So we do provide enterprise solutions, native or non-native to OFX. And obviously similar to our relationship, Jason, we're very proud of our partners as well. We do have a strong global partnership portfolio weekly.
Excellent. Thank you. Thank you so much, Michael. And look, I think that's all the questions we have, and a little bit after 3 minutes past. And thank you so much for your time. It's 11 in Sydney, so I know it's a bit late. Michael, again, thank you very much. To everyone on the line, thank you for, again, spending an hour of your time away from your family with us. Do appreciate joining, and we will send a link to a video once it's up and uploaded to YouTube. Do stay tuned for further webinars we will be holding. But again, Michael, thank you so much.
Thank you, Jason. Appreciate it.
Excellent. Thanks, everyone. Good night.